6 years ago, a man named Daniel walked into a car dealership with a credit score of 608. The finance manager ran his numbers, leaned back in his chair, and slid a paper across the desk. 18.9% interest rate, 5-year loan on a $32,000 vehicle. Daniel did the math quietly. That rate would cost him over $16,000 in interest alone. He asked if there was anything he could do to qualify for a better rate. The finance manager said, "Not today. Maybe in a year or two." Daniel walked out without signing. Not because he couldn't afford the payment, because something about that answer felt wrong. He spent the next 11 weeks learning everything he could about how credit scores actually work. Not the surface-level advice everyone already knows, the actual mechanics, the rules underneath the rules. 11 weeks later, Daniel walked back into that dealership. Same man, same job, same income. Credit score, 749. The finance manager pulled his file and actually paused. "Did you open a lot of new accounts?" Daniel smiled. "No, I just learned how the system actually calculates things." That 141-point jump saved Daniel over $11,400 in interest on that single loan. And that was just the beginning.
What Daniel discovered wasn't a trick in the way most people use that word. It wasn't a scheme. It wasn't disputing legitimate information or paying someone $500 to fix his credit. It was a set of mechanical features built directly into the credit scoring system that almost no consumer ever learns about. Features that wealthy people, mortgage brokers, and financial advisors have quietly used for decades. Features that banks understand perfectly and have zero financial incentive to explain to you. Today, I'm going to walk you through exactly what Daniel learned. By the end of this, you'll understand why the standard advice about building credit keeps most people trapped in expensive, high-interest territory far longer than they need to be. And more importantly, you'll know the exact path out.
Let's start with the problem that nobody in the financial industry wants to name directly. The conventional credit advice says the same thing it's always said. Pay your bills on time, keep your balances low, don't apply for too much credit at once, and wait. Wait patiently. Wait responsibly. Wait years. This advice isn't technically wrong. It's just incomplete in a way that costs you tens of thousands of dollars. Every month you spend in the fair or good credit categories instead of excellent is a month you're paying what I call the credit tax. Higher interest on your car loan, steeper rates on your mortgage, worse terms on your credit cards, higher insurance premiums in most states, larger security deposits on apartments.
The credit tax is invisible until you do the math. Then it's infuriating. And here's the part the banks will never put in a brochure. A customer with a 680 score is more profitable than a customer with a 780 score. They pay higher rates. They generate more interest revenue. They are, from the bank's perspective, a better customer to keep exactly where they are. The bank has no incentive to help you escape that category quickly. The slow path benefits them, not you. So what's the faster path? It starts with understanding what a credit score actually is. Your score is a statistical prediction, a number that estimates the probability you'll default on a debt within the next 24 months. The algorithm compares your financial behavior against millions of other consumers and identifies patterns associated with reliability or risk. The formula breaks down roughly like this. 35% is payment history. Have you paid your obligations on time? 30% is credit utilization. How much of your available credit are you currently using? 15% is length of credit history. How old are your accounts? What's the average age across all of them? 10% is credit mix. Do you have different types of accounts? 10% is new credit. Have you recently applied for new accounts? Most people accept these percentages and assume there's nothing to optimize. They assume payment history just means keep paying on time. They assume length of history just means wait longer. They're right about the input. They're completely wrong about the timeline.
Here's where the system reveals its first major hidden mechanism. The age of your credit history does not have to be the age of your own accounts. Read that again, because most people skip right past it. When you become an authorized user on someone else's credit card account, that account's entire history is imported to your credit report.
The account's age, its payment history, its credit limit, its utilization, all of it appears on your report as if you had been part of that account from the very beginning. If your father opened a credit card in 1998 with perfect payment history and you're added as an authorized user today, that 27-year-old account appears on your credit report immediately. Your average account age could jump from 3 years to 15 years within a single billing cycle. Your total available credit could double. Your score could move more in 60 days than it would in 3 years of simply waiting. This is the authorized user strategy. It is not a secret to people inside the credit industry. Mortgage brokers know it, wealth managers know it, the banks absolutely know it. It's simply never advertised to consumers because there's no profit in helping you improve your position faster.
Let me show you how this works in a real example. Julia was 27 years old, working her first serious job, trying to qualify for her first apartment in a competitive rental market. Her credit score was 614. Every landlord she approached either rejected her outright or demanded 3 months of security deposit up front. Her aunt had 2 credit cards. One opened in 2001, one opened in 2006, both with spotless payment histories. Combined limits over $45,000. Utilization consistently under 4%. Julia's aunt added her as an authorized user on both cards. She never handed Julia a physical card. She never gave her account access. The addition took about 8 minutes online. Within 2 billing cycles, Julia's credit report showed accounts with over 20 years of perfect history. Her average account age went from 2 years to over 11 years overnight. Her score jumped to 718. The same landlords who had rejected her now approved her application with a standard 1-month deposit. One conversation with her aunt, 8 minutes of her aunt's time, changed the entire trajectory of Julia's financial life.
Now let me give you the complete strategic picture, because the authorized user approach is just the first mechanism. The second involves understanding exactly when your credit utilization is measured. Most people know utilization matters. Few people know when it's measured. Here's what they miss. Your utilization ratio is calculated based on the balance reported to the credit bureaus, which typically happens on your statement closing date, not your payment due date. These are 2 completely different dates. You could pay your card in full every single month, never pay $1 of interest, use your card responsibly for everything, and still be showing 60% utilization to the credit bureaus. How? If your card has a $4,000 limit and you charge $2,400 every month, that balance appears on your statement before you pay it off. That reported balance is what the bureaus see. That's the number that hurts your score. The fix is simple once you know it exists. Pay down your balance before your statement closing date, not just before your due date. Bring the balance to under 3% before the statement closes. Your reported utilization drops immediately. Your score can jump 20 to 40 points within a single billing cycle. No new accounts, no waiting. Just a calendar reminder and a payment timing adjustment.
The third mechanism involves credit limit increases and their underestimated power. Utilization is a ratio. You can improve it by reducing what you owe or by increasing what you're allowed to borrow. Most people only think about one side of that equation. Here's the part they miss. Many major credit card issuers will increase your credit limit with no hard inquiry on your credit report. American Express, Chase, Bank of America. You can request an increase online and they'll approve it using a soft pull that leaves zero trace on your credit file. If you're carrying $2,500 on a $6,000 limit, you're at 41% utilization. Get that limit raised to $12,000 and your utilization drops to 20% with no change in your actual balance. Request increases across all your cards every 6 to 12 months. Over several years, someone starting with $12,000 in total limits can accumulate $60,000 or more simply by asking periodically. Banks don't advertise this option. Higher limits mean better utilization metrics, mean better credit scores, mean you qualify for better rates elsewhere. From the bank's perspective, a customer who knows to ask for increases is a customer who costs them revenue.
The fourth mechanism is one almost nobody talks about. It's called rapid rescoring. When you're in the middle of a mortgage application, time is compressed. Normal credit reporting cycles take 30 to 45 days for changes to appear on your file. Rapid rescoring bypasses that entirely. Your mortgage lender can request that credit bureaus immediately update specific items on your report based on documentation you provide. Pay off a credit card balance? Provide proof to your lender. The updated balance can appear on your report within 72 hours. Rapid rescoring isn't available to consumers directly. It only exists through a lender during an active application. But knowing it exists means you can time your moves correctly. Don't improve your credit 3 months before applying for a mortgage and hope the changes hold. Make the improvements during the application window itself, where rapid rescoring can reflect them within days. The combination of paying down balances, adding authorized user accounts, and requesting limit increases executed with rapid rescoring can produce a 60 to 90 point jump during the application process itself. Before we get to the action plan, let me address the mistakes that destroy these strategies before they have a chance to work. The first mistake is choosing the wrong authorized user account. An account with high utilization hurts rather than helps. An account with even one missed payment imports that negative history alongside everything else. Vet every account carefully. Perfect history, low utilization, old age. Those are your 3 requirements. The second mistake is applying for new credit while executing these strategies. Every hard inquiry drops your score 5 to 10 points temporarily. Every new account reduces your average account age. People optimize with one hand and undermine with the other. Stop applying for anything while you're in improvement mode. The third mistake is inconsistent timing. Paying before statement close works only if you do it every single month. One cycle of high reported utilization can erase weeks of careful work. Set the calendar reminder now, a few days before your statement closes, every month without exception.
Here is the action plan, organized by where you're starting. If your score is below 650, the authorized user strategy is your highest leverage move. Identify family members or close contacts with accounts older than 10 years, perfect payment history, and low utilization. Ask to be added as an authorized user on 1 to 3 accounts. Simultaneously, pay down any balances to under 10% of limits before your next statement closes. Do not apply for any new credit during this period. If your score is between 650 and 720, you're in optimization territory. Request credit limit increases on every card you currently hold. Adjust payment timing to minimize your reported utilization. Consider the authorized user strategy if your account history is thin or younger than 5 years on average. If your score is above 720, you're in good standing, but optimization still compounds. The difference between 740 and 790 isn't just a number, it's a meaningfully lower interest rate on every major loan you take for life. Focus on utilization timing, limit increases, and maintaining the habits you've already built.
Here's the deeper truth that changes how you see all of this. The credit scoring system was not designed for your benefit. It was designed by lenders to predict risk for lenders. It was designed to help institutions decide how much to charge you, not to help you build wealth faster. The system reveals certain things and obscures others in ways that consistently serve institutional profit over consumer understanding. Banks don't explain the authorized user strategy because it shortens the time you spend paying high interest rates. Credit bureaus don't advertise utilization timing because complexity keeps consumers dependent, confused, and paying. The entire industry profits from people believing that credit improvement is slow, mysterious, and requires patience, or worse, paid help. The reality is different. Credit scoring follows rules. Those rules are knowable. Once known, they can be used. The gap between people who understand those rules and people who don't is a gap measured in hundreds of thousands of dollars across a lifetime. Lower mortgage rates, better auto financing, reduced insurance premiums, access to capital when opportunity appears. These aren't small differences. They are the difference between building wealth and funding someone else's. Daniel's 141-point jump in 11 weeks didn't just save him $11,400 on one car loan. It changed how every lender would see him for the rest of his life. The knowledge didn't expire. The advantage compounds. The trick millionaires use isn't spending money others don't have. It's understanding systems others were never taught. Now you understand this one. What you do with it is entirely up to you.